Okay, have you ever noticed something completely bizarre about how the world works? Whenever there's a major economic crisis, millions of ordinary people absolutely struggle. I mean, people lose jobs, families slash their spending, local businesses shut their doors forever, and retirement accounts take a massive beating. But somehow, right in the middle of all that chaos, the richest Americans often come out even wealthier than before. Seriously. Look at the 2020 economic shutdowns. While unemployment skyrocketed, billionaires actually saw their wealth increase by trillions. Trillions. It's a massive paradox, isn't it? How can a financial crisis that brings so much pain to so many people end up creating even more wealth for those at the very top?
Now, it is absolutely crucial to acknowledge the real, devastating hardship these downturns cause for everyday households. When we ask how the rich get richer during these brutal times, it's super easy to jump to conclusions and assume there's some shadowy secret conspiracy at play. But I want to clarify right off the bat, this isn't a conspiracy. No, it's simply the mechanics of how money, assets, and our financial systems actually function. Understanding this machinery is your first step to navigating it. Okay, let's dive into this explainer and see exactly how it happens.
Here's the roadmap for what we're covering today. First up, the crisis paradox. Second, the power of assets. Third, capitalizing on the crash. Fourth, psychology and policy. And finally, the ownership advantage. All right, let's kick things off with Section 1, the crisis paradox, fear versus opportunity. So, when most of us hear the word crisis, our brains immediately trigger this primal fear response. We think about rising unemployment, inflation, bankruptcies, and really just survival. We instantly cut expenses and try to protect whatever we have. But the wealthy? They view these exact same macroeconomic events through a totally different lens. Instead of seeing only danger, they actually see opportunity. And to understand why, we've got to look at how income is generated. The traditional middle-class model relies on wages, literally trading your time for a paycheck. But the wealth model, that relies on assets. Wealthy individuals earn a massive chunk of their money from things they already own, totally independent of how many hours they happen to work. Which brings us right to Section 2, the power of assets, what the wealthy own. And this brilliantly illustrates the core divide. Let's talk about the secret engine of wealth creation, the productive asset. What exactly is that? Well, these are investments like dividend-paying stocks, rental real estate, or equity in a business. The pure magic of a productive asset is that it generates value whether you're actively grinding away at a desk or fast asleep in your bed. During an economic boom, sure, these assets grow. But during a bust, possessing these assets and, crucially, having the means to acquire more of them is the fundamental dividing line. It literally dictates who merely survives a crisis and who actually thrives during one.
Moving right along to Section 3. Capitalizing on the crash, cash and credit.
So what actually happens in the chaotic action phase of a market crash? Think about that initial shock. Fear is super contagious, right? Everyday investors start to panic, selling off their stocks because they're absolutely terrified prices will just keep free-falling. They just want to stop the bleeding. But wealthy investors, who often maintain really substantial cash reserves, step in and do the exact opposite of the panicking crowd. When asset prices are in freefall, having cash available when literally no one else does makes you incredibly powerful. You act like a giant sponge, just soaking up discounted assets left and right.
Let's ground this with a quick micro scenario. Imagine a really solid, fundamentally strong company whose stock suddenly plunges from $100 a share down to $60 during a huge market panic. Now, a lot of people look at that massive drop and see absolute disaster. But a wealthy investor with cash on hand, they just see a 40% off Black Friday sale. They step right in and buy. If that company survives the crisis and eventually climbs back up to $100, that investor just secured a massive profit. What looked like a devastating crisis to one person became an incredible wealth-building opportunity for another.
But hey, it's not just about the cash you actually have, it's about the cash you can borrow. The stark reality of our financial system is that during turbulent times, banks get super nervous. They raise their standards. They tighten lending for average folks, making it way harder for ordinary consumers to get approved for loans. However, wealthy individuals usually have super strong credit histories, valuable collateral, and really established banking relationships. Because of this, they maintain incredibly easy access to financing. In fact, they can often borrow money at even lower interest rates to scoop up cheap real estate and discounted assets while everyone else is essentially locked out of the bank. It's an incredibly powerful structural advantage. Okay, let's shift gears to Section 4, Psychology and Policy, Surviving the Storm. Zooming out to the macro level here, we can see how corporate scale, investor psychology, and government interventions basically act as a massive tailwind for the rich,
Crises completely reshape the business landscape. Economic downturns are notoriously brutal for local mom-and-pop shops. Small businesses usually run on razor-thin profit margins, making them highly vulnerable to sudden drops in revenue. And sadly, many just don't make it. Meanwhile, large corporations, they have deep cash reserves and highly diversified operations. They don't just survive the downturn, they often swallow up massive market share as their smaller competitors fail. And guess who owns the shares in those giant corporations? Yep, wealthy investors. When the corporate giants get stronger, their shareholders just get richer.
Then you've got the psychological advantage. During a crisis, social media and news headlines are totally dominated by panic and dramatic day-to-day market swings. It's an exhausting emotional roller coaster. But experienced wealthy investors, they don't play the short game. They aren't staring at year 1. No way. They're looking way down the road at year 5 and year 10. They understand that downturns are just a normal part of the economic cycle. By keeping this calm 5 to 10-year strategic perspective, they completely avoid making panicked emotional decisions, which allows their investments to compound beautifully over the long run.
And of course, we absolutely cannot ignore the invisible hand of government policy. When an economy slows down, policymakers and central banks naturally step in to try and stabilize things. It honestly acts like gravity. Step 1, the economy slows. Step 2, to stimulate growth, central banks lower interest rates. Step 3, because money becomes way cheaper to borrow and savings accounts pay practically nothing, capital floods out of banks and rushes into investments like stocks and real estate. And finally, step 4, this massive influx of capital naturally inflates the prices of those underlying assets.
So who actually benefits from this? Well, because wealthy households already hold the vast majority of stocks, real estate, and private investments, they automatically capture the lion's share of these policy-driven gains. Non-asset owners? They capture almost none of it. The system, simply by trying to save the economy, inadvertently hits the gas pedal on the wealth of those who already own the assets. This leads us right to our final section, Section 5, the ownership advantage lessons for the future. So the crucial point is, how do we actually apply this? How do we apply these macroeconomic mechanics to our own lives? Look, if there is only one thing you take away from this entire explainer, please let it be this. The real difference isn't necessarily income. It is ownership. So many people focus entirely on how much money someone earns on their W-2. But as you've seen today, relying entirely on wages creates immense vulnerability when a downturn hits. True wealth, the kind that actually survives and thrives through a crisis, is built through ownership. Ownership of productive assets is your real vehicle for long-term financial resilience.
Building this kind of wealth is a marathon, guys, not a sprint. The people who successfully capitalized on crises didn't just get lucky on the random day the market crashed. They spent years preparing long beforehand. They built up their savings. They invested consistently, rain or shine. They managed their financial risk, and they stayed incredibly patient during the panic. They were ready because they poured the foundation long before the storm clouds ever rolled in.
Understanding exactly how wealth behaves during turbulent times completely flips how you look at the world. The next time a downturn hits, you won't just see what is being lost. You'll clearly see what is changing hands. So I want to leave you with a really thought-provoking question based on everything we've unpacked today. Do you think economic crises mainly create opportunities for those willing to prepare? Or do the sheer mechanics of our financial system mean they mostly just increase inequality? Take a moment to really think about that and how the power of ownership impacts your own financial journey.